This is your host, Nick Riley, and you're listening to the One Day Advice podcast. Together, we're going to take a ride inside the world of personal finance. I'm going to give you a fully transparent, behind-the-scenes look into the financial services industry, helping you to optimize your financial life along the way. Today, I have the pleasure of speaking with Kyle Lynch of Clover Hill CPA. It's been a long-anticipated episode to get him on the show, and Kyle's a guy that I've worked with for quite a few years now in the wealth management business, and he's a wealth of knowledge, no pun intended, around the tax planning space. And one of the things we're going to talk about today is the most recent proposal from President Biden around his tax proposal. And while it's not set in stone yet, there are some changes that I felt that needed to be mentioned for a lot of you listeners out there. So Kyle, welcome to the show.
Thanks, Nick. Yeah, and I appreciate the intro. And yeah, to piggyback on what Nick said, I've known him for a number of years and a trusted partner of mine. And we work on a number of clients together. And it's a great partnership because Nick's an expert on the financial side, and I purport to be an expert on the tax side too. So yeah, it's a good tandem. So.
Sounds good, Kyle. Well, before we get started into the nitty gritty tax stuff, let's give the listeners a little intro on yourself, how you got in the industry, and tell us a little bit about Clover Hill.
Sure. So I've been doing this for 11 years now, which is hard to believe, but I've worked for a number of kind of regional and larger firms, both in Seattle and San Francisco area. And then kind of in the depths of COVID, I decided to jump out on my own and start my own practice. So we're a two-man shop. We're in Bellevue, Washington. We focus mostly on high net worth individuals and families, small business owners, and people that just have taxes that have gotten too complicated for TurboTax, and they start needing a CPA, and that's where we come in. So.
Definitely. So how long has it been now since you've had your own practice?
We started in November of 2020. So Coming up on our 1-year anniversary.
Nice. Yeah. That's awesome. It's been great to kind of see your practice grow and everything. And you've been an absolute value add for many of my clients as well. So without further ado, let's kind of go into some of what was proposed in the most recent proposal from President Biden. I know there's lots of things around the estate side that we're not going to get into in this episode today, perhaps in a future episode, but mainly today would like to kind of get a high-level overview of what is in that proposal, some of the things that affect capital gains. I'm sure we'll talk about the Backdoor Roth that comes into effect before year end, and kind of wrap up with some of the timely things that people can be considering prior to year end. With these changes being made. So, Kyle, maybe you can give us an overview of what was proposed.
Sure. So I think we've, in the industry, we've been anticipating this for, probably better part of a year now. Well, ever since the 2020 election, really. And there were some proposals out, kind of preliminary proposals out in March and April that kind of scared some people. And the House and Ways Committee just kind of put out their proposal. It's a little bit more becoming a little bit more real now. So the gist of it is that tax rates are not going down. They most likely will be going up more or less across the board, and especially for high income earners and wealthier clients. The top tax rates are going to go up about 2-3% for most clients, and
back to the kind of the pre-Trump era tax rates, right?
Right, and kind of consolidating some of the brackets, so people will start hitting that higher income bracket or the higher tax bracket at lower income levels than they are currently.
And what is that at approximately $400,000 or so for single, $450,000 for married filing jointly?
That's been kind of the magic number, and then that's what's proposed in the House and Ways Committee right now. It's $400,000. That's been kind of decided to be the kind of the high income threshold is $400,000.
Yeah,
and kind of once you hit that level, there's a slew of other tax implications that have been proposed as well. But yeah, there's a number of the net investment income tax, the 3.8 net investment income tax is going to become a little bit more robust, apply to a lot more taxpayers. Business owners previously were exempt from that, and it looks like they would be subject to that going forward. A number of things like the Roth conversion you mentioned. They're eliminating qualified small business stock. They have, there's a lot to chew on there, and it applies to a lot of different taxpayers. So it's hard to give you the exact rundown of how it applies to you specifically without knowing your situation.
Of course, yeah.
But yeah, high level, taxes are going up, and there's things you can do now in the short to medium term to kind of mitigate any impact on you.
Okay, so speaking of kind of the things that people can do now, just I think it would be helpful because I haven't had an episode on the Backdoor Roth. Maybe just given a high level overview of how that operates, because that is one of the things that is in the proposal to be kind of end at the end of this year. So it might be the last chance for many of you listeners to be able to take advantage of this option. So Kyle, could you give us just an overview of how that works?
Sure thing. Yeah, and this hits home because I do the backdoor Roth conversion every year, and I've done so for the last 5 or 6 years. And it's a nice little kind of trick. If you're maxing out your retirement plan at work and are over the Roth IRA contribution limits, what you can do is do a non-deductible contribution to a traditional IRA, and then immediately convert it over to a Roth because Roth or traditional IRA conversions to a Roth are unlimited. You can do them as many times as you want. But now in the new proposal, they've kind of caught on to that, what's called the backdoor Roth, and that would be disallowed going forward. So the way it worked before is you'd put $6,000 into a traditional IRA, you'd roll it over to a Roth, and your basis in that traditional IRA is 6,000 because you never got a deduction for it. So you put it in after tax money, you never got a tax deduction. You roll over 6,000, and there's no taxable income on that conversion. But yeah, going forward, you wouldn't be allowed to do that. You'd just be subject to the IRA contribution limits the IRS sets out for all taxpayers.
Yeah.
So.
Yeah, and there are typically three classifications in those types of contributions. You have the pre-tax, like otherwise known as kind of the traditional contributions. You've got the after-tax, and then also the Roth. So a lot of this is being applied to those after-tax contributions, correct?
Correct. Yeah.
Great, and that is something that in the proposal, at least, if it were to pass, which this probably is pretty likely, I would say on this passing through legislation. But what can people do before the year end to take advantage of this?
Yeah, so I mean, in an environment of tax rates rising, or maybe your tax impact will be more next year than this year. Right now would be a good time for a Roth conversion, accelerating income. If you can take advantage of the 22 or 24% tax bracket, whereas next year you could be in the 32 to 35% bracket with a similar level of income. You're saving 10% in taxes by accomplishing that by the end of the year. And just in general, I'm a big fan of Roth IRAs. I think I don't think tax rates are going to go down in our lifetime. And I think the premise of traditional IRA is that your tax rate will be lower in your retirement years, but I don't know if that'll necessarily be true 30, 40 years from now. If you're younger.
And I would say too, from a planning perspective, yes, you get that upfront tax benefit or tax relief by contributing to that traditional. It grows tax deferred. But when you are in retirement and you're planning on drawing from your retirement funds for income purposes, if you have a $1 million traditional IRA or old traditional 401k, that might only be worth $600,000, depending on your tax rate at the time. Whereas if you contribute to a Roth and you've got $1 million in your Roth balance, that's actually $1 million that you'll have access to from a cash flow planning perspective. So when you're talking through how to plan around income in retirement, it's much more predictable knowing how much you'll have in that Roth format.
Yeah, and the Roth isn't subject to a lot of the rules the traditional IRA is in your retirement years. There's no required minimum distributions in retirement, so you can keep as much money as you want in your Roth IRA. Um, it's better to pass on to your kids because they don't have to pay tax on it. You know, the traditional IRA doesn't get the step up in basis,
Mm-hmm.
um, and you know all the deferred growth in a traditional IRA comes out as ordinary income as well. You don't get the capital gain rates like you would, even in a taxable brokerage account. And so that's why I prefer Roth.
Yeah.
It can make sense, if you're a high income earner now, getting that tax deduction for a pre-tax 401k or a traditional IRA can make sense in a lot of cases. But yeah, I think for a lot of kind of middle income taxpayers, Roth is a great route to go.
Absolutely. And I think it's worth mentioning while we're talking on the Roth subject too. One of the many things that a lot of the clients I work with don't know or didn't know prior to working with me is that the Roth IRA has contribution income limits. So if you're trying to contribute to a Roth IRA, you will be subject to, depending on your income, whether you file single tax filer, that's $140,000. If you're married and filing jointly, if your income is over $208,000, you won't qualify for a Roth IRA contribution. However, if you have a 401k option through your employer, they will oftentimes offer a Roth 401k contribution option, and that is not subject to any income limits. So if you are a high earning individual or high earning household and want to take advantage of this Roth opportunity, which, like Kyle mentioned, I think is going to be the best in the long run for a majority of people that can let those Roth assets continue to grow tax-free. Just take advantage of your Roth 401k contributions and make sure that you're maxing that out. And if you ever leave that employer, you can roll that into a Roth IRA. And that's just one of the ways of kind of bypassing those income limitations.
Yeah, that's a good point. It's high income earners can still take advantage of that. They just can't get it outside of their 401k or through their employer.
Yeah, definitely. So the other part of the proposal was around capital gains. So maybe we can just spend a little overview on how capital gains tax will be changing. I know it's going to be retroactive as well potentially. Maybe give an overview of that.
Sure. So in March, April, there was people were kind of flipping out because one of the proposals was that high income earners wouldn't get the preferential long term capital gains rates. So long-term capital gains rates have been lower than short-term capital gain rates since I think 1917, and it's been kind of a long tenet of tax law that capital at risk in the economy is good and incentivizes investment and long-term investment. And one of the things in March and April is that would go away for anybody over $1 million in income. The proposal that came out last week was a little bit more watered down, and it was 25% would be the new capital gains rates for high income earners, and that's anybody above 400,000. So they increased the base by quite a bit and lowered the rate. So it should be pretty close revenue wise to the proposal in March and April, but maybe a little bit more palatable for a lot more people.
Yeah, because I think the original proposal was for income earners over $1 million, and I think the surprising factor was that they actually reduced that income threshold down to the $400,000 mark for single filers. So it's actually going to affect far more people than that original proposal would have.
Right. And then, for high income earners, you also have the 3.8% net investment income tax. So long-term capital gains, if you have long-term capital gains in your portfolio and you're in the higher brackets, you're looking at 28.8% at the top level.
Yeah.
And so the proposal that came out last week said that would go into effect September 13th. And so we're at September 23rd. So in that case, it would be too late. Now, when these bills typically take longer to eventually pass than usually planned, and that September 13th date could change. But the gist of and how it applies to you is that by the time it passes, it's going to be too late to sell off and get grandfathered into the old 20% rate. Now, if you sold everything today, you have a higher likelihood of getting grandfathered in, but I wouldn't guarantee that or recommend acting on that for the most part. But if you're deciding between selling something now and December 1st, now would be a better time to do it.
Yeah. And ultimately, a phrase I always like to use is don't let the tax tail wag the dog. So don't make your decisions purely because of taxes or anticipated taxes. You really want to look at your personal situation, what is best for you, your household, and your household financials. So, Kyle, I think we've kind of covered enough of the proposal today, but I know we'll have future episodes on other tax planning items. I'd love to have you on the show again. But yeah, thanks for giving the listeners an overview of this most recent proposal.
Of course, yeah. And I know I rambled on in some places, so if you ever have any questions or follow-up, please feel free to reach out to Nick or myself. Our contact information will be available. And
yeah, I'll make sure everything's in the show notes, and people know how to contact me and get a hold of you, Kyle, as well.
Perfect. Well, thank you again, Nick, and thanks for having me on. Glad we were able to do this, and look forward to the next one.
Sounds good.
Hi, I'm Nick Riley, the founder of One Day Advice. If you like what you've heard, we'd greatly appreciate your help in spreading the word. After all, we are financial educators, not marketers. Thanks for listening, and remember to leave us a review.
Nick Riley is the founder of One Day Advice, an independent fiduciary and fee-only registered investment advisor. Nick serves as a wealth advisor and educator to his clients. All opinions expressed by Nick and podcast guests are solely their own opinions and do not reflect the opinion of One Day Advice. This podcast is for informational purposes only and should not be relied upon as a basis for investment or financial decisions.